shelter costs and housing, Dana, there's a bit of a weird calculation method here where what we look at is probably in the past. There's a debate right now when shelter starts to come off and housing prices start to come off. When do you think that's going to happen, if at all?
Sure. Well, home price valuations for both new and existing home sales have already started to come off, but we don't see that reflected in rents, which is what you're seeing in the CPI for a pretty significant lag, something like 18 months. So most likely we'll start to see the CPI cool, the shelter elements cool in either late spring or early summer of this year.
Okay, so where does this leave the Fed?
Well, the Fed is already expecting this. This is what they keep saying, that it's in tow, this disinflation from housing. What they're really concerned about is services away from housing. And services prices have been rising, one, because there's a lot of demand for services now that people are free and they're not locked down, but also because of wages. We have very elevated wages in the U.S. reflecting labor shortages, especially in those experiential services like hotels and restaurants, entertainment, and travel.
Dana, is there a sense that we're still waiting for the pass-through? Because there's a bit of head-scratching still as to why we continue to see, price pressures still pretty strong.
Well, the thing is that we are seeing price pressures come off for durable goods, and that's because durable goods are usually financed, right? And interest rates have been rising very aggressively, very rapidly over the last year. They're up 5 percentage points. And so, yes, people are buying fewer cars and furniture and anything that they need to finance, like boats. But when it comes to services, usually people pay cash or they pay with credit cards. And we've seen credit card use go up. And so really what you need is softening in the labor market for people to stop purchasing services. And I think that's what the Fed is looking for.
Are you starting to see a significant softening when it comes to the labor market? We have headline after headline when it comes to certainly layoffs and labor market weakness in specific sectors. But has that fed through to the broader picture?
Well, net job gains month after month are less robust. So going from 500,000 to 300,000 to 200,000, that's still a lot of people being hired. But when you dig beneath the surface, you can see that absolutely that the weaknesses in industries that were booming during the pandemic and aren't now that the pandemic is over. So that includes technology, real estate, construction, finance, also transportation and warehousing. But you still have a lot of hiring in those industries where you physically have to show up to work. And again, those are those experiential services. And so that's offsetting, the hiring there is offsetting the weakness that we're seeing in the sectors that were previously pandemic darlings.
Dana, to Heidi's point, when does this all hit us, the lag effect? I mean, people seem to forget that the Fed only started hiking rates, 13 months ago. Do you think they've done almost enough, or have we just not waited long enough?
Well, lags are variable. So certainly we've seen the impact on the housing market. Home sales, transactions are down, as well as prices. And we've already seen the action again in durable goods. Non-durable goods are food and energy that are affected by external forces. But with services, that's probably going to take longer to happen. And so the Fed probably has about 2 more interest rate hikes at most, at minimum 1, 25 basis points each.